welcome to the NASDAQ studios in Times Square, New York. This is The Corner TV, and today we bring you an interesting interview. We're talking about investment and technology with a company called TICC and its CEO, Jonathan Cohen. Thanks for being with us.
Thank you.
So, Mr. Cohen, tell us a little bit what you do. What's your company?
TICC Capital Corp is an investment company that makes investments in corporate debt. So we started out years ago investing directly and making loans directly to technology companies in the United States. We have migrated that strategy over the years. We're now more diversified. We're still investing in corporate debt. And our stock is a dividend-focused stock. In other words, we are producing a dividend, a yield for our shareholders.
So how do you monetize it? How does it work for your clients?
From an investor's perspective, they make an investment. They buy shares either in the primary market through an IPO initially or through secondary offerings, or in the secondary market, buying stocks in the stock exchange, buying stock in the stock exchange. We then take that capital and make investments in corporate loans, pools of corporate loans that are called CLOs, collateralized loan obligations, and other sort of corporate debt instruments that produce a yield to us, which we pass through to our common stockholders.
What's the main difference between you and a bank that does market making?
Well, we tend to invest in smaller companies. So banks make all sorts of investments to very large companies. Banks invest in things or make loans to support commercial real estate, residential real estate. We're really focused on the middle market and larger portion of the corporate loan market, as opposed to what is called the asset-backed market, investing in things like pools of residential real estate loans, or car loans, or credit card receivables, or things like that, which we're not involved in.
Let's get to it. Is there a risk of a bubble on the tech stocks or not?
There's always a risk of a bubble in the tech stocks. I think the risk is probably greater at this moment than it has been in recent history. Since the bursting of the technology bubble of the late 1990s, technology has been in sort of a slow and steady resurgence, really over a very long period of time. And I think there are certainly pockets of bubbles being produced and sustaining in the market today, but there are still pockets of opportunity.
The OECD says that investment is going to increase radically in the next years in the US, so from a 3% to a 7.7% increase.
Yes.
What's your take on that?
Well, from a macro perspective, I think the US market continues to be perhaps the dominant opportunity across the globe right now. We're seeing middle market loan opportunities. We're seeing opportunities with larger companies. We're seeing opportunities in the M&A markets. So we continue to see very strong opportunities across the U.S. market set.
There's a lot of money out there right now. Is that bad for a company like yours?
Well, it's good and bad. Inexpensive money, readily available capital decreases our cost of capital, the cost that we pay either for raising equity or raising debt, but it also reduces the return that we have the ability to generate in terms of deploying that capital once we raise it. The issue for us is, on a sort of ongoing basis, is the balance between those two endpoints and how ultimately we generate some sort of a positive return between our cost of capital and our use of proceeds. Historically, I think we've done a reasonably good job of doing that over the last 10 years.
Tell me three things that you consider when picking a stock or a debt issue today.
Well, when we're looking at corporate debt issues, we're looking at a whole range of things. Mostly what we're concerned about is our ability to generate a high rate of risk-adjusted return. In other words, we want to be assured with some high level of probability and certainty that these companies have the ability financially to repay their indebtedness. We also want to make sure that the money that we are lending them, either directly or through a syndication, is being productively deployed. So we want to make sure that their use of proceeds is better than their cost of capital so that they can grow and prosper and ultimately repay us with the interest that we've agreed to. Lastly, we want to make sure that these investments make strategic sense, that ultimately these companies are engaged in productive activities, that they're doing things that make sense commercially, and that they are a viable participant in whatever market they happen to be engaged in.
You say you invest up to 30 million per investment. Doesn't that distort the market?
Well, our investments are relatively small in the scheme of the overall investment market that we participate in. So the corporate loan market is many, many hundreds of billions of dollars in absolute size. 30 million may seem like a large number, but in the context of the investments that we're making, those tend to be fairly small investments overall.
What's your forecast for 2014?
Our forecast is uncertainty. We have very little certainty given the state of global markets, given the behaviors and the prospective behaviors of state actors worldwide with respect to GDP growth or interest rate forecasts or corporate spread activity. What we are hopeful of is that the markets will continue to be generally constructive and productive, and that we will have the continued ability to generate a positive and strong risk-adjusted return for our shareholders.
And my last question, the main challenge ahead for you?
The main challenge in an uncertain and changing global market is to ensure that we're making the right kinds of investments for the right reasons.
Thank you very much for being with us today.